All right, let's get started. Thank you everyone for joining us today for the second iteration of our Navigating the Virus Crisis webinar series. My name is Blair Modica, and today I'm joined by David Bassanese, our Chief Economist. We hope today we can give you some clarity on the ongoing situation, and with a bit of luck, hopefully this crisis passes soon. Please bear with us if there's any audio issues. David and I are in different states, but we don't anticipate any major issues popping up. Before we start, just some quick housekeeping. A recording of the session will be made available to every attendee at the end of the webinar. We will also take questions at the end, so please have them ready to go. You can place your questions in the text box on your go-to application and we will answer them from there. Furthermore, all information given in this update is general in nature and doesn't constitute personal financial advice. Finally, I just wanted to make you aware of the different content we are producing throughout the crisis. As normal, our website continues to provide fun data, blogs and investment information. If you haven't, I would encourage you to sign up for David's Bassanese Bites, a weekly publication on the way he sees the market. Please also feel free to direct questions and ideas to us via our social channels. So, as I mentioned, my name's Blair Modica. I've been at BetaShares for over 3 years now. Joined with me today is our Chief Economist, David Bassanese. And for those that don't know, prior to BetaShares, David was an economic columnist for the Australian Financial Review for over a decade. And prior to the AFR, David spent several years in financial markets as a senior economist and interest rate strategist at Bankers Trust and Macquarie Bank. So in terms of today's agenda, we're going to run through the COVID-19 update, the coronavirus, and where we see it affecting markets and the overall macro economy at this point in time. David will then give you a market outlook on the way he sees the market, and I will run through some investment ideas off the back of that. So you'll hear from me a little bit later on with some investment ideas, but I'll now hand over to David to give you a bit of an update on the coronavirus and the overall macroeconomic picture. David.
Thanks very much, Blair, and thank you everybody for joining us today. Look, the purpose of this presentation is really to give an update, a running update given the sheer volatility and information going on in the markets, as timely as we can. Now, some of this does go on, in terms of structure, a little bit over old ground. We just did a webinar a couple of weeks ago. Some of you may have participated in that. Some of you may be new. So some of what I will say will be going over some familiar ground, but there is a lot of people who are brand new to the webinar today that weren't around a fortnight ago. So just bear with me if some of you may have heard some of the things I say before, but I will be providing an update nonetheless on the current situation. So just to start with, why are we where we are in terms of this coronavirus? Haven't we had influenzas in the past or pandemics? Why is this one special? And I've just got a list there of all the various, major pandemics globally that have afflicted us. Most famously, the Black Death, back in the 1300s. Really, some estimates say it wiped out half the European population at the time. That was terrible because A, it was very contagious, but B, it had a very high death rate of something like 80% as well. Spanish flu in 1918, you got to sort of, again, that was an influenza. Well, Black Death wasn't influenza, it was something else, but the Spanish flu was an influenza, again, highly contagious and had a particularly high death rate back in 1918, not helped by the fact that obviously the health systems over 100 years ago weren't as good as they are today. Something like 50 to 100 million people around the world were estimated to have died because of the Spanish flu. The death rate there, 25 million based on 500 million being affected, give you a death rate about 5%. Now, more recently, we had the Asian flu, the Hong Kong flu, and most recently the swine flu in 2009, which again, when influenzas, typically, again, widespread infection rates, estimates vary, but something like 30 to 60% of the global population were affected. But the important thing is that the effective death rate of those was certainly not as high as the Spanish flu or the Black Death, still around about 0.1% or so. And so we didn't get the and we didn't get the rush to the hospitals in the same way as well. So these were pandemics that were widespread, but not as severe. Now, the problem with the more recent one we had was, of course, was SARS, the SARS outbreak in 2003, which is below the coronavirus. And again, the SARS was a serious ailment, and that if you did get it, the death rate was around about 10%, and if you got it, you knew you got it pretty quickly. So the good news, at least of that, is you couldn't spread it that widely, because it was pretty clear who had it and who didn't, and so you could basically go to hospital and get treated pretty quickly. Now, coronavirus, unfortunately, somewhere in between the two, is as widespread as the previous flu outbreaks, the Asian flu, Hong Kong flu. But again, experts are still debating this, but it does suggest that the death rate is notably higher than certainly the most recent, the swine flu in 2009. And so the issue is that, you know, if everyone gets it at the same time, it will clog up the hospital system. Many people that could have survived, would they to get treatment, would not survive because they couldn't basically get medical treatment. And so we've really been dealing in a way that the swine flu wasn't an issue so much for financial markets in 2009. This one is, because of the higher lethality of it. And really, so this is what we've been facing. If you just go to the next slide, some projections as to why we're doing what we've been doing. This is a projection from Imperial College London, probably the experts in the field here, and they showed that if we did nothing and we allowed the virus, and this is the case in the United States, we allowed the virus to sort of run its course through the community, they would say something like 200, you know, at its peak, something like you'd need 200 critical beds per 100,000 of population at its peak, which is close to where the US is at the moment in terms of the sort of peak infection rates, which is something like 30 times more than the number of ICU beds available in the US. And this is similar around the world. Basically, when you think about it, you know, we don't build hospital capacity to deal with pandemics, right? Because it'd just be hugely costly to maintain that sort of spare capacity just for these, you know, 1 in, you know, 20, 30, 50-year events. So, but if we did nothing, we'd have a complete hospital overrun and many people would die. That's what the scientists are saying. So what we found, China basically, who went into this first, did a lockdown, eventually had to do a lockdown, you know, telling people to stay indoors. Most non-essential businesses were closed down. And we were like, you know, horrified at what China had done. But the reality is what China did back in January, February is what most countries have had to do since. And that's why the initial sell-off in the equity market that began in February has turned into a much major sell-off as these lockdowns have effectively caused a global recession. Now, so again, the scenarios there, you know, if we close schools and universities, if we do social distancing as what we're doing now, there's a good chance we can avoid that peak. Now, this scenario actually had these measures in place. If you look at it, 1, 2, 3, 4, 5 months. So they actually say these need to be in place for quite a long period to avoid that overrun of the hospital system. And even then, when you remove those restrictions, there's a risk of a second wave of infections. And again, in 1918, when they removed restrictions, because they actually did similar type of restrictions. If you look back in the United States, for example, they then got a second wave because basically you haven't built what's called herd immunity. You know, we're still as susceptible to the virus as we were before. And so, but what they do, what the scientists say is you need to manage that. So you sort of partly open up the economy, let more people get infected. Some of those will need hospital treatment, but we can manage it. And so it's a sort of gradual easing of those restrictions is the sort of the way the scientists would have you believe. Now the markets are like, you know, rejoicing at the fact that we're at a peak infection rate and you know, we can sort of go back to normal very, very quickly. But this just shows you that the reality is that, you know, until such time as there's a vaccine, we may not be able to lift these restrictions that quickly at the risk of having a second wave. So if you go look around the world at the moment, just looking at the next chart, I mean, just quite staggering photos. You know, there's Venice, New York, Sydney, Paris, you know, streets that are deserted. This is like, you know, you think back to the night, no, not that many of us can remember, but the Great Depression of the 1930s, even then we had people walking around the streets. I mean, it's just extraordinary what we're seeing at the moment. So basically we were in depression conditions, albeit for hopefully a relatively short time. And again, governments today are debating how quickly we can lift these restrictions. Now, some of the good news in that area, if you look at, just going to the next chart, the signs of infection, this is the rate of, what economists like myself are now focused on are these, if we just flick to the next slide there, the signs of peaking, yeah. So this is the rate of daily rate of increase in new infections. So the number of new cases globally, and as you can see, it ramped up through March, tentative signs of an easing. Though, you know, we are hearing reports that emerging markets, you know, Brazil, Africa, a lot of other countries still possibly need to, you know, deal with this virus, and maybe we haven't seen the end. But at the moment, there's, you know, tentative signs of peaking globally. Most importantly, if you go to the next slide, some of the most hurt countries in the developed world, as in Europe and the United States, this is what's getting markets excited at the moment, is that, yes, they ramped up, but Italy went into lockdown over a month ago, and you're seeing signs that the rate of new infections is starting to come off. And very, very tentatively, the US also, you know, market's getting very excited that we're hitting the peak rate of infections, and maybe they will start to ease over the next few weeks. And then, you know, hopefully that then means that we can ease the social distancing restrictions that are in place, and therefore economic growth can get back to normal. But again, the big question is, how fast will governments allow these social restrictions to be lifted, and what risk do we face of a second wave of infections? And one area to look at carefully in that regard is in Asia, which basically had this first. So as we know, it started in China, spread to countries like Singapore, South Korea. Now, these countries have a lot of experience. If we just go to the next slide there on the Asian markets. So they've dealt with SARS in the past, and obviously the Hong Kong and the Asian flu back in the 1950s and 60s. So the Asian countries do have some experience in how to deal with pandemics, and so they're very good at testing, isolating. So basically, the ideal way to deal with these outbreaks is that as soon as someone presents with a case, you quarantine them, you trace everybody that they've had any contact with over the last few weeks, test all of those. If any of those have any infection, you quarantine them as well, and you really try to close it down. And that's what they did with the SARS outbreak back in 2003, and why it didn't spread to Europe and the United States. So we've seen Singapore, South Korea, they did have a pickup in infections, but again, it hasn't gone away. So if you look at Singapore, it actually just more recently we've had a pickup in infections, and Singapore, which did have some restrictions in place and eased them, has basically put them back on in the last week or so. So they've closed down schools again. They've had to close down some non-essential businesses, encouraging people to work from home. Look at South Korea. I mean, they've still done a good job. They've reached a peak of infections. It's still burbling along in South Korea at a manageable pace. But again, you just want to watch that. And again, they're so good at testing, tracing, quarantining that we haven't had a flare-up in South Korea, but nor have they really eased a lot of their restrictions yet either. So we're still in that sort of holding pattern. The challenge for the rest of us, like Australia, Europe, and the United States, is when and if we lift restrictions, or when we do, I mean, we'll eventually, will we be as diligent in testing, tracing, quarantining cases as they are in Asia? Because if we're not, then we're even more prone to the second wave of infections. Just some charts there. Look, these are a little bit out of date now, but just to show you the way these have, how the rate of infections have panned out around the world. Basically, you've had this takeoff in various countries, and usually then they've gone into lockdown when you get to a critical level of, you know, around about 1,000 or so cases, or even somewhat earlier. And usually within 30 days, we're seeing evidence that those lockdowns have an effect. The good news is that lockdowns do seem, as you would expect, if no one can sort of, you know, interact, you would think the rate of infection would start to die down, and we're sort of seeing that in obviously in China, to some extent Italy, and hopefully some of these other countries. Just looking at it by city, same sort of story. I won't really dwell on that, but again, this is what's getting the markets excited at the moment. If you just go to the next slide there on the Chinese PMI index. So this is a survey of again, a couple of weeks ago, I had the survey where it had slumped to February, you know, very weak manufacturing indicators in China. Since they've eased restrictions, some workers have been able to go back to factories. production starting to pick up, albeit their export markets are still largely closed. You've had a nice rebound in these PMI indicators or these manufacturing indicators in March. Now, again, just to be cautious a little bit about those numbers, what that's basically saying is in March, around about 45% of businesses reported better conditions than they had in February. But it still means that conditions are still pretty weak. They're just on balance better than they were in February. So it still means that overall manufacturing activity is still pretty subdued in China, but they've all, everyone's sort of a good degree of businesses have had better times because of the restrictions being eased, and so that's what we've seen. And so the hope is, when we go down the markets are basically starting to price in an eventual peak in the US rate of infection, an eventual easing of restrictions in the US, and an eventual bounce back in economic growth. Even before we've seen much sign, again, a lot of this data is lagged, so we haven't really seen a lot of the weakness in the US data yet. We've seen some signs, but a lot more is to come. And just to give you an example here, on the next slide is US weekly jobless claims. So this is probably the most timely indicator on the US economy. So it's the number of people that front up at state employment offices around the country asking for unemployment benefits. In previous recessions, it's got as high as 600, 700,000. Prior to the coronavirus, it was at a 50-year low of about 250,000. 2 weeks ago, it shot up to 3 million. Like 3 million people applied for unemployment benefits within the week in the US, and last week it hit 6 million. And this week the numbers are around about 6 to 9 million, another huge increase. So that just shows you the magnitude of the shock to the US economy. So we're talking about the unemployment rate in the US over the next 3 months, probably going from a low recently of 3.5% to a high of around 15% or so. As all those workers, basically stay unemployed, and we have these shutdowns across the country. But again, at the moment, the markets are looking through this quite remarkably, and they're saying, yes, things are horrible, but we think as we get on top of the infection rate and things we can ease these restrictions, we'll get through it. So it's a question of, how quickly basically the markets are pricing in a V-shaped recovery, which I still am a little bit cautious about, and I certainly at the current levels, I'd be cautious about, jumping into the market at the moment, because I think there's a bit more of a reality check that would need to come through. Just looking at some of the, what do we need to see a V-shaped recovery? Well, firstly, there's going to be a lag before restrictions are lifted. I mean, even in Europe, they're announcing extensions of the lockdowns. In China, they have eased restrictions, but there's still, if you look at the Wuhan province, for example, which was the epicenter of this outbreak, they've now allowed travel for some, provided they've got a certificate to show they don't have the infection. Many apartment blocks are still shut down, but there's been a gradual return. And again, we just have to wait and see that there's no second wave that picks up in China. The other thing is, even when we do lift restrictions, I think business and consumer confidence is going to take some time to recover. Business, and again, look at the US, the collapse in oil prices means that the oil sector there is going to remain very weak, which is not great for US business investment. And importantly, and I'll touch on this in a minute, corporate earnings have only just begun to be slashed, and the markets haven't focused on what that will do to valuations. If you actually price in the likely decline in earnings over the coming year, the market's trading at quite high valuations. Now, market will do what the market does, but it just, to me, I think it's a strain that they can sustain those high valuations given all this uncertainty about how quickly the economy will bounce back. The ultimate hope, of course, is the vaccine situation and or better drug treatments. We've just got a slide there of looking at this is ultimately what will see us out of this, is once we have a vaccine. Again, the optimists think it can be done in 6 months. The scientists and the realists still say 12 to 18 months. There are some various drugs that are being touted that's having mixed evidence, I would say, that maybe doesn't cure or prevent the influenza, but it can treat the symptoms once you get them. So there are a lot of experiments going on there, but so I've just got a chart there from the Economist looking at all the various things that are being tested. So tests are underway. And again, maybe one scenario is that we do start to lift restrictions and there will be better drugs available, such that if people do get infected, we're more confident that we can treat them in hospital, and as a result, we can sort of ease restrictions more and be able to be more confident we can deal with the infections in hospitals as they arise. So it's that balancing act at the moment of risks of second wave versus costs to the economy by persisting with shutdowns versus how effectively can we treat people with this with the drugs that are becoming available. In terms of the market outlook, I'll just really conclude on a couple of comments here. First, if we go to the next slide in terms of bear markets, and so what I've got there is the US declines, US bear markets. So bear markets is when the market has declined more than 20% from its previous peak level. And I've split that in the US from periods that were recessions. So again, there's a group in the US that actually define when a recession takes place in the US, the National Bureau of Economic Research. They haven't made that judgment as yet for 2020, but it's a pretty sure bet that they will eventually make that judgment. So we can basically be pretty confident we are in recession in the US. So as you can see, in recession periods, historically at least, the markets have taken a long time to reach their bear market lows, typically around about 12 months or so. Obviously in the Great Depression it was a lot longer, but a rule of thumb would be around about 12 months, and the market bottom can be, you know, back in the high inflation era when nominal earnings growth was still positive, the declines were less. But in the more recent recessions, we've had declines of around about 50% or so during a recession. So again, at the moment, if you look at that blue line, now that blue line, if you updated it, that's at the market low of 35%, 34% decline in the market. It is now rebounded about 20%. So the market is now down only around 20% from its lows in the US. So that blue line there has had quite a remarkable rebound. But as you can see, bear market rallies, rebounds after an initial slump are not unusual. We can get waves of those, and then the markets go on to form new lows. So look, we could have seen the bottom, don't get me wrong, but it depends on how far markets want to rule out. But I would say, given the market has rebounded to the extent it has, and given the uncertainty I still think we're going to face over the next few months, my suspicion is that we're going to at least retest the previous lows, if not eventually go lower over the next few months, given that we are clearly in recession. Now, just to give you one example of that, on the next slide is the dividend. This is a chart of what the market, there's a futures market in the level of dividends in the US for say 2021. So this is what the market, if you can bet on what you think dividends will be at the end of next year. And at the moment, you can see that has slumped from around about 60, or an index level of 60, to around about 39. So it's been quite a large slump in earnings. And if you actually factor in, you know, what the dividend yield, what a relevant dividend yield would be if that is true. So if the estimate of dividends next year is at 39, with a dividend yield of around about 2% in the US, you actually get a US market trading at 1800, or S&P trading at about 1800 versus like 2700 at the moment. I've done some other numbers. I just did them recently. If you factor in that the US earnings this year are, say, down 35%, it's a bit complicated the way forward earnings markets are priced versus forward earnings, which is a weighted average of expected earnings this year and earnings for next year. If you factor in a 35% decline in earnings eventually being priced in by analysts this year, and even allowing for them pricing in a 20% rebound in earnings next year, my calculations of what forward earnings would be still decline significantly over the next few months. And in fact, the market at current levels is trading at 23 times what forward earnings would be around about in August, depending on those assumptions. So look, I think it's pretty clear the earnings outlook for this year will need to be downgraded. And with that, it would tend to drag down the level of earnings for next year as well, even though the analysts will still be pricing in some recovery next year, but the level of earnings will be lower than what they are now. So net, I guess my concern is the market is still, doesn't seem to be factoring in the significant decline in earnings that are likely, and is really too keen to sort of look through that. I mean, you can't trade at 23 times earnings in an environment where you're still very uncertain as to whether or not you're going to get a V-shaped recovery or not, would be just my view. Look, just to go through, I mean, if you look at about the cycle, I mean, this is a different cycle though. And again, so usually in recessions, what happens is, economic data starts to weaken. The very smart economists out there can guess that there's a recession happening. The share market weakens, and then we get further confirmation of weakness through the data. And so the market sort of declined gradually because it's still only tentative evidence of a recession appearing in the data. This time the economy's been slammed by the lockdown. So we know everyone virtually knew a recession was happening almost instantaneously at the same time. So that's why the market, fell in such a big way initially before the data has even reacted. And so that's why we've had a lot of the weakness sort of front run. And so what we've had is rising infection rates, reactive policy responses, share markets declining in anticipation of the economic weakness. And only now we're starting to get the weak economic data at the same time as the markets are sort of starting to ignore that cycle on the first cycle there and are jumping across the falling infection rates, share market stabilizing, in fact more than that now rebounding, and on the hope of an easing in policy restrictions. But where they may come unstuck is the speed with which economic data does tend to improve, and I think that's where the disappointment may come. And even worse, that falling infection rates are questioned, and that if we do get a second wave as restrictions are eased. But look, that's the situation at the moment. There are various scenarios. My colleague Blair is going to run through some investment ideas for various scenarios, and we've got to be open to various scenarios. It's very uncertain environment. So the best case scenario, basically the market is now operating on a V-shaped recovery scenario. So they see containment within weeks, and they see a gradual easing of restrictions and no second wave, and we can sort of get back to normal, maybe by the December quarter, the September quarter. So September quarter economic growth in the US being positive. And really, so that would suggest we have seen the lows. Maybe the market will pull back a little bit from here, but not retest the lows that we saw in late March. So that's a scenario. Maybe that's a 25% probability or 30% probability. Mike, I'm still kind of in the U camp here. I think there's probably more uncertainty to come. I think the lockdowns will be a bit more gradual than the markets are hoping for, and you can't really rule out those second waves, as I mentioned before. And that would, if we got a second wave and the US eased restrictions and then had to reimpose them, or if we did see those being reimposed in a bigger way in Europe and or Asia, that would really be a body blow to the markets, I think. And then the worst case is where these, some people are saying, the New South Wales Premier is saying she's going to keep the state in lockdown until a vaccine arrives. Well, I mean, that would be, being in lockdown for 12 months or so. That's just an extraordinary, that's unlikely, but that's the sort of worst case scenario, in which case we haven't seen the lows and the markets can head a lot lower. So I'm hoping for a V, but I mean, I'm cautious, and and certainly, again, since I gave this webinar last, a couple of weeks ago, the markets have moved a long way. They're focusing on the fact that lockdowns are horrible, but we're seeing tentative signs of an easing in the infection rate in the US, hopefully, and that maybe means that they can ease their restrictions. And so they're counting on a V, but the reality I still think is we may get a U. But on that, I will hand over to my colleague Blair to go through some of the scenarios and some investment ideas for those various situations.
Great, thank you for the update, David. And just quickly, I've noticed a lot of questions coming through. Please keep them coming. We'll cover them off at the end. So thank you for that. As David said, I'm going to give everyone some investment ideas to fit in with the three scenarios he just pointed out. So the V, U, and L-shaped recovery. So to listeners who've logged onto to the last webinar, these will be reasonably familiar. These opportunities remain consistent with the existing scenarios. We're just showing them as an opportunity to express your view of the market. So I'll start with the V-shaped scenario. People who believe the V-shaped scenario will play out think that the market will recover quickly and will return to normality quickly. So what are some ideas off the back of this? We think there's three key ways to express this view. Via low-cost, broad-based Australian equities, technology, and through enhanced exposure via geared funds. So if you're expecting the worst is behind us and a V-shaped recovery to pre-crisis, A200 is a simple, transparent way to take a positive view with the lowest cost for broad-based Aussie market exposure. So what the chart in front of you is showing is the impact cost can have on a portfolio. So at 7 basis points, you can benefit from market recovery in a really inexpensive way. So just to reiterate here, the ticker code to express your view on Australian equities is A200, and that's a 7 basis point fee, the lowest in the market. Moving on, and I guess another V-shaped scenario where you could benefit is by using the NASDAQ. So given a V-shaped scenario, you might expect a period of earnings disruption, most impacting companies with heavy debt loads and narrow operating leverage. In this case, you want business models less impacted by disruption. So that is, they make money while you sleep, shop online or watch Netflix. So with huge cash reserves and low to zero dividend payout ratios, companies like Apple, Microsoft, Amazon and Alphabet are not only well positioned to weather the current market storm, but when the dust finally settles, they may end up in a stronger position to displace old economy incumbents. So if you think of that like Amazon versus a brick and mortar retail business, what the NASDAQ's, what the NASDAQ's giving you, and that's expressed via the ticker code NDQ, is access to the top 100 stocks listed on the NASDAQ. And given the cashed up technology firms included in this index, we think this may represent a good opportunity in a V-shaped recovery. So just to reiterate, NDQ again is the ticker code, and that's available at 48 basis points. Moving on, I guess the next one to look at is geared equities funds. So again, the last idea for a V-shaped recovery using gearing. So GEAR is the ticker code for Enhanced Australian Equities Exposure, and GGUS is for Enhanced US Equities Exposure. So the funds themselves are internally geared, meaning all gearing obligations are met by the funds such that there are no possibilities of margin calls for investors. The fund also combines funds received from investors with borrowed funds and invests the proceeds into a portfolio that manages exposure to a broadly diversified share portfolio consisting of the underlying shares of their respective indexes by market capitalisation. So you're looking at the ASX 200 and the S&P 500, but they're enhanced by gearing. The fund's gearing ratio, which is the total amount borrowed expressed as a percentage of the total assets of the fund, is managed between 50 to 65%. So these funds represent a good way to enhance returns in a period of market recovery. Both of the funds are available at 80 basis points, and the ticker codes again, GEAR and GGUS. So moving on to the next scenario, a U-shaped recovery. So the worst is almost over, but there's a slow recovery ahead. And I guess two trading ideas here that we've come up with are quality companies and hybrids, and hybrids particularly over bank equity. And I'll discuss these over the next couple of slides. So first looking at, I guess, global quality leaders as an investment piece. So given uncertainty, better to be positioned in a portfolio of high quality global companies with lower debt, higher earnings certainty and strong profitability. So with the BetaShares global quality leaders, there's a natural tilt to healthcare at 33% and technology stocks 23%, with lower allocations to consumer discretionary at 12%, financials at 7%, and real estate at 1% in particular. So if we look at this chart, you can see firstly, if you look at the arrows in red, we can see that, that at the start of the GFC through the first half of 2008, the global quality leaders index drawdown is roughly in line with the broader market. A similar pattern has been born out of the current virus crisis, with quality and the broader world index both drawing down approximately 20% in Australian dollar terms. So often we see this increase in correlation at the initial stages of a market shock as investors look for the doors and all risk assets fall together. However, after the GFC market shock, we can see that the quality index has a max drawdown of only about half that of the broader market, and quality really started to recover far earlier and faster. Now, we put these reasons down, or they may have been, that investors came to the realization that not all stocks are equal. They start to differentiate and gravitate towards those with strong return on equity, lower earnings volatility, and lower debt. So hence, if you believe the worst of the market falls are behind us in the current crisis, but the path to recovery is potentially a long one, then getting exposure to quality global companies may make a lot of sense. Again, reiterating the ticker code here, QLTY, BetaShares Global Quality Leaders, and that's available at 35 basis points. The next U-shaped performer could be hybrids, and in particular, HBRD, the BetaShares fund, which is a basket of hybrids within the market. So the chart in front of you is showing 5-year major bank hybrid credit spreads blowing out to 650 basis points as at the 18th of March. And this is a result of the volatility induced by the corona crisis, which is really wider than the GFC. Again, if you believe the worst is behind us, but the path to recovery is long and grinding, you then may believe that hybrid offers highly attractive mix of capital gains, firstly from spread compression, gross yield, which is currently 8.3%, and a higher degree of capital stability to equities, which is giving you strong risk-adjusted returns. So Coolabah Capital, the manager of this fund, are very bullish on hybrids over the next 12 months. And in terms of guidance, they've compared this to the GFC, and in particular bank issuers. So comparing bank issuers prior to the GFC to now, they've reduced their leverage from around 21 times in 2007 to around 8 times today in risk-weighted terms. So, I mean, that means increased equity to capital buffers, de-risk their business in complexity and credit risk lending standards, and they enjoy stronger government and regulatory support, and I guess via government guaranteed bank deposit, precedence of government guaranteed wholesale term funding, access to emergency funding via the RBA's post-GFC committed liquidity facility, and they've recently announced support for credit activity, again by the RBA. They've also generally de-risked their business models and increased the conservatism of their lending standards. So here, mean reversion might be amplified by the fact that global central banks and treasuries have moved more quickly than at any other time historically to boost economies with huge monetary and fiscal stimulus. And that includes unrestricted QE extending to the purchase of corporate bonds and direct loans to companies. So we feel that hybrid and the hybrid fund certainly represents a good opportunity given that U-shaped recovery scenario. Finally, I just wanted to touch on the last scenario, and that's the L-shape. The worst is yet to come. And I guess some trading ideas here are so forth. There's a few that I've put together. Blair, BBOZ and BBUS are the short funds that we have available in our suite. And what these do is allow clients to hedge out their long positions or take a bearish view and profit from the market declining. The next one is AAA cash, and that's essentially paying out 75 basis points as an interest rate distribution to clients, and that's a significant pickup on what clients might be receiving on platform. QAU is popular in terms of market uncertainty, so that's a pure gold exposure. It's also currency hedged, which we feel could be beneficial given current Australian dollar weakness. AGVT, or I guess government fixed interest, government bonds, and what they do is provide an opportunity to profit from quantitative easing measures and further rate cuts. And the last one I've got on there, and I will go into these in a little bit more detail over the next couple of slides, is WRLD and AUST, so WRLD and AUST are the ticker codes. What those two funds do is apply a handbrake to equities. So as volatility increases in the market, the funds increase their hedged exposure and dial down volatility. And we'll show you in a second that they've been very successful over this recent market drawdown. So the chart you've got here, again, L-shaped scenario looking at the bear funds and in particular the ticker code BEAR. So that's a short fund giving you one-for-one exposure to market falls. And what the chart's showing you there is it's done exactly what it's designed to do. Again, looking at AAA cash, as I mentioned, a 0.75% yield. And you can see there that what we give you with all of our cash and fixed income funds is monthly cash distributions. And as you can see, a big pickup on broker cash and savings accounts, and very comparable to a one-year term deposit. So if you look at that 75 basis points net of fees, comparable to a one-year term deposit, but certainly a massive pickup for an average online savings account at 0.14%. And if you look at an online broker cash account, 0.01 is the average there. So by simply using AAA cash, which invests in bank deposits, you're getting a big pickup on your cash distributions. Again, paid monthly. Another one is, again, the risk managed suite. And I've got AUST here as an example. That's our Australian fund, which is providing risk management overlay over the top of the ASX 200. And what we're showing here in the chart is that as volatility is picked up in the market, the risk management strategies kicked in. So you can see from a volatility point of view, AUST has performed strongly and protected investors from wider drawdowns in the wider ASX 200 market. So that's it from me in terms of an investment point of view. We will take questions in a second, but as with any investment, there are risks, and I'd encourage you to look through the risks of each fund. But thank you very much for listening today. I'll just look through the questions. I know there's plenty coming through, and we'll get back to you in a second. I know David's ready here to answer anything you may like, so please keep them coming through. So David, have I still got you on the line?
I'm here, Blair.
Great, David. So the first question for you, we're just getting a few questions to come through specifically for you. Just your views on the US dollar.
Look, US dollar is basically at the moment still it's a risk. It's obviously a risk on, risk off question. So if you are risk off, like if you're in the more, we haven't seen the worst yet, and markets are probably going to peel back from here, the US dollar is going to strengthen because it's a safe haven currency, and by consequence, the Aussie dollar will weaken. So again, the Aussie dollar has had a rebound with the rebound in equity markets in the last few weeks for the reasons I explained. I wouldn't be chasing it at these levels. I think again, if I'm right and the markets peel back somewhat over the next few weeks, once the celebration of peak infection rate in the US is priced fully in the market, I think the Aussie may weaken again and the US dollar strengthen.
Great. And David, while we've got you, there's plenty of questions coming through about market volatility, and I guess people are saying that they've never seen this level of volatility, and asking the question, is it more to do with algorithmic trading? Is it ETFs or massive stimulus responses? So I guess in general, explaining volatility maybe against the GFC or prior volatile periods, is there any difference here?
Look, a couple of responses to that. It is importantly, it's not ETFs. It's not, I mean, when you think, just a quick comment on ETFs, obviously people are using ETFs a lot more than they've done in the past. But if you actually look at the volumes of traded on ETFs in a given day, the actual net change in the holdings of shares is not that much. So what you find with ETF trading is there's a lot of buyers and a lot of sellers on any given day. And so they're not really shifting the market around all that much. Look, so-called logarithmic trading, technical trading, that's been around for a long time. I mean, that's not new. Now, the share of the market traded by computers is obviously higher these days. So a lot of it is technical and volatile. But my more broader point is that when you're in a bear market, when you've had a, most unprecedented economic development in, probably since the Great Depression, really, this is probably the biggest shock to the system since the Great Depression. You're going to get volatility. You're going to get a lot of uncertainty, and typically in a bear market, the volatility is high. And so, as some point out, I mean, it's great when the market's up 7% in a day or 5% or whatever, but if you actually go back in history and say, well, what are the periods in which you typically get these big moves? It's in bear markets. So basically, it does tell me, we're in a bear market, and that's when you do get these volatility tends to pick up. And just by the way, that feature of bear markets, the fact that volatility tends to pick up when markets are weak, is one of the rules that our risk managed ETF, AUST and WRLD, that Blair mentioned. They actually use that sort of tendency of markets to be volatile in periods of weakness as one of their rules in which they do their hedging. So just bear that in mind. But yeah, volatility is just a factor that it's been a huge economic shock, a lot of debate. We all know the economy is incredibly weak. And then the big debate now is it a V-shaped recovery or a U-shaped recovery? And there's just a huge amount of uncertainty about that, overlaid with the fact that in a bear market, you're always going to get a heightened volatility.
David, you talked about the US probably being in recession. We've got a couple of questions here just about at home. We're talking about interest rates, so they've never been so low. Does this affect the chance of a recession here, and what are your views here?
I can tell you there's a 100% chance that we are in recession, so there's no question we are in recession. The unemployment, I didn't really talk about Australia all that much because, look, if to the extent you care about the equity market, it's really that global infection rate going on and what Wall Street does. I mean, again, those that have listened to me in the past, I focus a lot on Wall Street because that's really what drives our market ultimately. And so, but just in terms of the economy here, I mean, the good news is that the government, it's really like the central banks have been good globally in that they have made the situation would have been a lot worse were central banks not providing liquidity. So basically what you've had is companies around the world draining their, building up their cash balances because they had massive revenue shortfalls. Now, if the central banks weren't providing a lot of liquidity, basically providing cash so that they can run those down, you would have seen a lot more selling of other assets and a lot more weakness. So they've limited some of the downsides. So that's what monetary policy has been doing. Interest rates are zero, so interest rate declines have had really no effect, but it's been the behind the scenes liquidity provisions by central banks that have been more important this time around. But the other big thing, particularly in Australia, has been fiscal stimulus, and so and particularly the wage subsidy that is announced. So the government is basically offering a wage subsidy to up to half the workforce, basically 6 million workers they budgeted for, $130 billion. Now, what that means is that whereas the unemployment rate might have hit 15% by some estimates in Australia over the next few months, it's now likely to only hit maybe 7, 8, 9%. So a halving of how high the unemployment rate will get. But be under no illusion, shutdowns are having a massive economic cost. The unemployment rate will go up, and a lot of people will be, concerned about their job outlook, which is going to have an impact on house prices. It's going to have a massive impact on the corporate earnings outlook as well. I mean, some analysts are out there today saying banks may not pay a dividend this year. And, our market is up today on the back of the US market going up. And could you imagine talk of banks not paying dividends this year and our market going up? It just shows you how, almost crazy we are at the moment, but also how slavishly we follow what's happening in the US. But my comments about the US corporate earnings outlook also apply in Australia. We're facing a massive decrease in the earnings numbers over the next few months, which the markets at the moment haven't really priced in. They're sort of trying to look through that and focus on 2021 earnings. But I would still argue that even 2021 earnings will be a lot lower than what they are at the moment.
Great, David. We'll keep you on the line. There is a few more, but just a couple coming through for me. First of all, there was a question just regarding when we speak about the market, what market are we referring to? And I think David just cleared that up, but certainly in most cases through the presentation, we're talking about the global market. Another one here, will gear always remain open on market, or is there a point where it can close due to the loans to value ratio? It's a good question. So we manage the loans to value ratio at 50 to 65%. So as it falls out of that parameter on any day, we rebalance it back to the mean at the high 50s there. And this allows us to keep it going at any time without losing the value of the fund. So it's the gearing ratio is managed for exactly that point. So it will remain open on market. Another question regarding QLTY, our quality fund. So I said that it was available at 45 basis points. What does that mean? That's just the cost of the fund. So 0.45% is what it's costing you over a yearly period. So a relatively inexpensive way to access quality companies. There's another question here. Is QAU backed by real gold per dollar or synthetic? I can confirm that that is the gold bullion that we hold is held in a bank account in London. So that is a backed by real gold product or investment. Another one here, what is the AU impact on NDQ? What bearing does it have? So NDQ is currently unhedged to the US dollar. So if you do feel that the market in Australia, the Aussie dollar is going to improve, that will reflect negatively on returns in USD denominated funds like Dave, another one. I mean, we've got a question. The World Trade Organization says we're heading for a depression. What are your thoughts on that?
Look, again, we are in a depression. The global economy today is in a depression. Be under no illusion. I mean, you can't shut down the economy, the vast swathes of your industry and not be in depression. The question is how long we'll be in depression. Now, the 1930s depression went on for, it was not I mean, in fact, today, economic conditions are weaker today than they were at any given point in the 1930s. But the difference between the 1930s and today is that went on for 10 years because there wasn't any macro stimulus. So we had a big downturn following the Wall Street crash in the 1930s, and governments and central banks at the time, this is before Maynard Keynes told us about counter-cyclical policy, basically saw they needed to tighten their belts rather than actually provide stimulus. So it actually made the situation worse. The good news today is central banks and governments know to do counter-cyclical policy. So we're not going to get a 10-year depression. And again, as soon as restrictions are eased, the vaccine is developed, we will get out of this and we will recover. But the debate at the moment is not, are we in depression? We are in depression. It's a question of how quickly we can get out and maybe move to like a more normal recession. So again, my base case is that things will get, relatively better as we start to ease restrictions, but we're still looking at pretty weak growth for, recessionary conditions for several more months, if not a year, depending on, again, one thing, changes in consumer behavior and whatever. So so the debate is not whether we're in depression. Yes, we are. It's a question of how quickly we get out of that, and what the sort of other side looks like. And I don't think we're going to stay as weak as we are at the moment. Yeah, that's probably all I want to say, I think.
Great, David, thank you. And thank you everyone for joining today. Unfortunately, we're out of time, but if there are any questions that haven't been answered, I'd encourage you to direct them to our social media pages. We're more than happy to get in touch and answer them for you. But once again, thank you very much for your time. Obviously appreciate it given the circumstances. We all hope you stay safe and enjoy a few days off over the Easter period. So thank you very much.
Thanks very much, everybody.